I once learned from an old Wall Street broker, 10 rules of thumbs when coming to investments. During the long life of trading, he had made many mistakes of trading before he ended up very successful and full of good knowledge. I will in this video share all his 10 rules of thumb, so you can be inspired, and hopefully more successful in your investments. This is only general advice that have worked for others. Investment is always associated with a risk. By following the 10 advice I now will present, your chances to be one of the few percents making money on stock will increase sharply. 4% Rule. Rule of 72. Rule of 114. Rule of 144. How much to invest in bonds? 5 to 25 Rule. 7-year Rule. Stock market average return. The 5% Rule. 10/5/3 Rule. The 4% Rule. You can withdraw 4% of your portfolio every year and never run out of money. If you have a $1.5 million portfolio, you can withdraw $60,000 a year. Some say it should be 3%. Others say it should be 6%. I like to meet everyone in the middle at 4%. The Rule of 72. How long it'll take for your investments to double in value. Calculated by dividing your expected rate of return from 72. Here's what it looks like with an 8% return. 72 divided by 8 is equal to 9 years to double. But there's also another way to use this rule of thumb. It can also tell you your required rate of return. If you want to double your money in 10 years, the rule of 72 will tell you what percent return you need. 72/10 years equals 7.2% return required. In other words, you need a 7.2% return to double your money in 10 years. The Rule of 114. Similar to the Rule of 72, this rule shows you how many years it takes to triple your money. Calculate by dividing 114 by your expected rate of return. 114 divided by 8% return equals 14 years to triple your investment. The Rule of 144. Similar to the Rule of 114, this rule shows you how many years it takes to quadruple your money. How much to invest in bonds? Tradition says invest your age as a percent of bonds. So a 20-year-old will have bonds make up 20% of their portfolio. That's too conservative, even for the risk-averse. So if you want bonds in your portfolio, invest 120 minus your age in them. The 5-25 Rule. When to rebalance your assets. If large asset classes increase or decrease by an absolute 5%, it's time to rebalance. If small asset classes increase or decrease by 25% of their size, it's time to rebalance. The 7-year Rule. If you want to be conservative, don't invest money you expect to need in the next 7 years. If you want to be aggressive, don't invest money you'll need in the next 5 years. Stocks are volatile. Not investing short-term money ensures it doesn't lose value. Stock market average return. On average, the stock market has returned 10% a year over its lifetime. If you want to be aggressive in your calculations, assume 10%. If you want to be conservative, assume 8%. Then calculate the impact of inflation. The 5% Rule. No more than 5% of your portfolio should be in a single stock. Tying your net worth to an individual company is risky. Limiting each company to 5% of your portfolio hedges against that risk. The 10-5-3 Rule. The long-term average annual rate of return for stocks, bonds, and other cash equivalents. Stocks, 10%. Bonds, 5%. CDs, HYSAs, etc., 3%. This may not always be accurate in the short term, but these have been the historical average return over the long term. Thank you for watching. I hope you learned something useful in this video. A final tip when coming to investing in stocks. Don't get emotional, always make a plan and stick to it. Please like and subscribe to our channel to get more useful advice and wisdom.